Good morning and welcome to our very first In the Room live webinar of 2024. My name is Arifa Essop and I will be hosting the series going forward. You will remember that my colleague Stephen Backhouse used to host this session before. Steve is now at a new role within the Stand-Up Asset Management team. We wish you all the very best in your new role, Steve-o. Today I'm in the beautiful Cape Town offices of Allan Gray, and with me is Duncan Artus, the Chief Investment Officer. Welcome, Duncan. Thank you so much for taking some time out from managing clients' money to be with me today.
That's great. I'm actually going to Franschhoek this afternoon, so it's not all work.
That's great stuff. Duncan, when I was doing research before this webinar, I noticed that you and I have been in the organization, or each of our respective organizations, since 2001. So I remember the day very clearly. I was 5. How about you? How did you get, what's your backstory? How did you get into the industry?
It's an interesting story. So my grandfather was always very interested in shares. In fact, the very first share I ever owned, he bought for me and it went to 0. So it was a very good lesson about how hard investing is. And then actually my dad was interested as well. And for those of people who are a little bit older, if you remember in the stock exchange, if you go and look at those videos, there used to be guys running with a piece of chalk who would do the things at the JSE. My dad actually did that as a job when he was younger. So it was naturally on a Sunday, people would open the Sunday Times. I know it's hard to believe in today's internet. You'd have that page and have all the share prices, and people would almost look only once a week at where the shares were. So naturally, a little bit it came through. I did business science at UCT. Then I did my postgraduate in accounting. And as most people, sort of the benchmark was you had to become a CA. Okay. So interestingly enough, I did my GDA, then I lasted 2 weeks at KPMG. And then I was like, this is not for me. And it was actually a little bit less than our chairman, Ian Little, my old boss, said. He lasted only like 3 months. So 2 of the most senior people at Allan Gray are failed accountants.
Was it the numbers that got you?
No, it was sitting doing auditing for 3 years. It wasn't for me because I was interested in markets. And then actually, just as a little side story, funny enough, we actually managed part of KPMG's pension fund, and I did the very first report back.
Okay.
And I was there in sort of next to Wits, where their offices are there on Empire Road. Mm-hmm. And I said to them, I used to work at KPMG. They're like, no, Duncan, we'd remember you. I said, no, I only lasted 2 weeks. I said, well, at least we know you can make quick decisions.
There we go.
So then, when I left there, I had a little bit of an internship at a small stockbroker, and I worked at a small asset management company called Greenwich for a year, which is actually very important, because I think if you come straight to a company as big as Stanlib or Allan Gray, like it's a little bit different. You need to be like in a small place where people don't treat you as well on the outside, and clients can be a little bit difficult. And actually, Greenwich at that time used to run the Rainmaker Fund before Tim Alsop took it over. Okay. And I guess Ned Group, Truffle, I think, run it now. And I worked there for a year, and they were going to be bought at Old Mutual. And sorry, guys, no things for life companies, but I didn't want to work. I didn't want to work for a big life company. And I was very fortunate. Sometimes your life takes a fork in the road or whatever. And the building I lived in Newlands, Sam Howley lived the floor below me, and Sam was one of the analysts at Allan Gray, and we obviously met at sort of things where you meet management and stuff. Sam went on to be head of equities at Investec and ABSA, for people who don't know. And he was like, if you don't want to come for an interview at Allan Gray, and I met Simon Murray. He was like, for those of you who know, Simon was an interesting guy. He's like, you can have a chance, whatever. And then I came for a second round of interviews, and I'm not sure about this, but I think I was the last person interviewed by Allan himself. Okay. So he used to come 2 weeks a year to Cape Town. And I went through the whole interview process, and I was very lucky. Got through, and it was also the next sort of 5 or 6 years were like that golden period for Allan Gray, even though maybe 2002 wasn't that great, but we just had like this huge alpha, and the firm obviously grew massively. So that's kind of how I ended up here. And I guess I'm always grateful that the firm trusted. I mean, Ian and myself were appointed portfolio managers in 2005. So we only had 4 years investment experience, and we already appointed portfolio manager Allan Gray, which I think, if we did it today, some of the stand-up multi-managers and people would freak out a little bit.
And as they say, the rest is history, right?
Yeah.
So, and in those 23 years, which is quite an impressive tenure, if I say so myself, same as me, you have been part of celebrating Allan Gray's 50th anniversary, which is a huge milestone. So congratulations on that milestone. What would you say is the, when you're reflecting on that journey, what would you say is the biggest lessons you've learned along the way?
So thanks. Yeah, we actually had in November, we had the function here. It was great. We had a whole lot of clients and ex-staff and people flew in from around the world. So it was pretty humbling to see it. So I think the sort of couple of lessons we take from it, you can put it into firm lessons and then investment lessons. I think firm lessons, it is incredibly hard to outperform for long periods. And we just know that from the numbers if you look back. Sort of the second lesson is, it's amazing, like science, if we look at like what's happening in AI now, engineering, knowledge is cumulative. Like we went to the moon, you can do stuff. But investments, we make exactly the same mistakes as the Dutch people did during the tulip mania or the South Sea bubble or the tech bubble. So
markets are cyclical.
Yeah, well, it's human emotions, right? It's sort of fear. Sort of the other thing we've learned is, I think what Allan always believed when he came back from working in Fidelity and he came to Cape Town to set it up was, you can actually invest in businesses separately from the economy. And actually, in fact, it's interesting, some of the best businesses do better when the economy is poor, because obviously their competitors are weaker and they don't do as much. And one of the great sort of insights Allan had when he came was, in South Africa, it wasn't a very sophisticated market, and he'd come back from America and he just bought companies that had very high returns on capital that could reinvest. It was Rembrandt at the time, so it's one of the great investments we made at the beginning. So you can invest in companies, not necessarily economies, which is quite an interesting thing for today, if you think how nervous everyone is about South Africa. The other thing is, like, you have these big trends. So while we bottom-up investors, you kind of need to be aware of the situation. So if we go 1982, interest rates peaked in the US, and it went all the way to the tech bubble. You were in a different environment, and it's exactly what we've been saying to clients over the last few years. We sort of think 2020, the environment changed. It's a little bit higher inflation, it's a little bit higher interest rates. Things are going to be different, even though it hasn't obviously worked the last few months. And you just need to be aware of where you are. And I guess as a business, we've thought a lot. We have a slide where we show the Alexander Forbes Large Manager Watch from 1992. Most of the people don't exist anymore. Interestingly enough, Stanlib still exists, but then it was Standard Asset Management, but like very few asset managers still exist. So you don't want to ever get complacent. I remember when I started, the biggest unit trust manager was BOE. The building right next to us, they don't even exist anymore. They're somewhere in Ned Group, right? So, and the Investec small cap fund was the unit trust getting all the flows. So you never want to be complacent. It's a very competitive market. And the way I kind of think about it is each unit of alpha, in other words, each unit of outperformance, I think in 2024 is far more valuable than it was in 2001 when I started, right? Because South Africa is an incredibly competitive asset management industry. Now, I actually think our asset management industry is one of the few things in South Africa that's world class.
That's really interesting. You mentioned something that I picked up. Rembrandt was one of the very first shares that you had invested in. Is there other shares that you have held on to from then? Because Allan Gray is typically a long-term investment house.
Normally when we've held shares for that long, it means we've got something wrong. But no, so I mean, obviously the market, if you go back to then, there are very few shares that are still in the same thing. In the early years when we had exchange controls and apartheid, remember it was a bit of a hothouse effect. So Anglos, Sanlam, Bulletin, all these companies owned each other, and so it was quite a hothouse effect. But no, there have been like businesses that we've done well. In fact, an interesting story, a former colleague of mine, Heaton, and I, we went to go present to some potential people who wanted to invest in South Africa and Sweden, which was quite interesting. And we met like a fund manager who made his entire career on H&M.
Oh.
He just kept it for 20 years, and as soon as it got too big in a portfolio, he just sold. So, I mean, invariably, if you look at the Dow Jones, where we've got a long history, I think it's only General Electric that's still left. So companies fail, they morph into different things. So it's unlikely you're going to own companies for that long. But yeah, there are one or two companies we've owned my entire career since we've been here. And it probably wouldn't be the case if we were an asset manager in America, where there's a lot more options than in South Africa, yeah.
For sure. And you said, okay, so you've spoken about the business more than anything else. Are there any personal lessons that you've learned for yourself that you take away?
Again, I'd just say that sort of first lesson, that investing is very humbling. As soon as you get too arrogant, as soon as things are going very well, the nature of like working at Allan Gray and being a contrarian investor, as soon as things are going well, I'm already thinking what's going to go wrong. Which is maybe a bit of a weird way to look at life, but it's just something that's come through. So yeah, as I say, outperforming over the long term is hard. And then I guess sort of the other things I've learned sort of is if you work with great people, which I've been fortunate enough, so Simon Murray, Stephen Mildenhall, Ari, Ian, Andrew, Simon Robenheimer, all my good friends, Delphine. If you work with good people, it's easier to attract good people. Right?
Yes.
And it's like this weird sort of thing that's hard to explain to people on the outside. Because asset management is a human capital business, right? So Allan Gray, we actually don't even own this building, right? We lease it from Growth Point. We've got some plants at the studio we're sitting in. But all we have left is a cost base and people, right? So it's very important to sort of get the right people over time. And then I guess sort of the most sort of humbling thing for me was sort of the respect Allan Gray's generated over the years. So when I was 24, a young analyst, so I was the banking analyst for a long time. So I have looked at Standard Bank for 24 years. So gone through from Jacko to Sim to Bruce Hemphill, everybody.
Some names.
So I actually was taking over coverage of First Rand from Simon Murray. I was 24, and we were going to meet them for results at Great Westerford. And Simon phoned in sick. And I had to go by myself as a 24-year-old, and you walk into this big boardroom, and there's G.T. Ferreira, Larry Dippenaar, Paul Harris, Michael Jordan, Johan Berger, and I'm like, oh, geez.
The pressure.
But they thought I was good because I came from Allan Gray.
Okay, so the name.
And I had to prove them wrong, right? And I think that's one of the lessons I've sort of learned, and we try inculcate in the investment team, is that you got this whole legacy behind you. And so when you meet management, be prepared. Like when you meet people, you got this whole sort of people you're representing. And also I think over the years, which is the one interesting thing for the advisors, is, as I said, human behavior stays the same. And the weird thing is, if people listened to exactly what you tell your clients and what we tell clients, Allan Gray wouldn't have a business because people wouldn't make stupid investment decisions, right? So we exist. As you know, most of our fees are performance fees. So we exist on people making bad investment decisions, even though we try every day to tell them not to make bad investment decisions. So that's the other thing I've learned. You go there and people are going to make the sort of same mistakes and do the same things over and over.
So Duncan, you said two things. You're a bottom-up manager and contrarian.
Yeah.
So it comes up very often for Allan Gray. What do you mean by contrarian? What does that mean? And why is it important for Allan Gray?
Okay, so maybe let's just take, because some people so bottom-up means, so Allan, when he came back from Fidelity, and we still believe this today, so like, understand the businesses you invest in. Macro forecasting is extremely difficult. In your next few webinars, you can bring some of the smartest people here, bring 5 Nobel laureates in economy, and they'll give you exactly the opposite views, and they'll argue very credibly. So we only really sort of take macroeconomic views at extremes.
Okay.
And we think that's the right thing to do, but generally it's pretty difficult.
What does that mean?
So if the Rand weakened by 100%, right, that would feel like quite extreme to me. Or, you know, just like if you look across the world, you look at
inflation goes like
you look at Japan in 1990, right? Tokyo, the Imperial Palace, was worth more than California. Okay. That's an extreme, right? And when Allan started Orbis, he had 0 weighting in Japan. So I think the thing about being contrarian, it sounds easier than it is, right? So if we just think logically, you can invest passive, right? You can just go in the index, so you're guaranteed to underperform the index by fees, right? If you go passive, whichever one is. So how do you outperform? The only way you can outperform is you look different from the index and you look different from most of your competitors. And invariably, the market is right most of the time, right? So to be contrarian, you know, that's the only way you're really going to get alpha. But one of the best quotes I've heard is someone called Mark Farbo, who I've read for like 24 years. He's sort of and he said, if you're being contrarian, it helps knowing what you're being contrarian about. right? So like in the US now, if you're contrarian, you wouldn't own the big tech stocks. But that's not been a good idea, right? From a fundamental point of view as well, because they've actually grown their
Everybody's going into those.
their intrinsic value quite a bit. And so it can be very lonely. And as I say, like you don't want to be contrarian for the sake of being contrarian, right? So like today, as an example, we own no Richemont, we own no Anglo-American, no MTN. We don't do that just because everyone else owns them. We do it because we actually believe in those fundamental sort of differences. But yeah, I think contrarian is important. And yeah, as I said, the only way you can outperform your peers and the market is really to look different. But it's hard. And what we try to tell people is to interrogate while we do it. And as I mentioned earlier, I've been here so long that it actually just becomes part of you. Like if I read in the newspaper, like, oh, this is happening, I'm going, why is it not true? Or something. So it is a little bit, it does become a little bit, sometimes a glass half empty type of way of looking at things.
So has there ever been a time when your contrarian approach has not done what it should have done for you, or you got it wrong?
Sure. So it happens loads of times, right? Especially on individual shares. So just to put it in context, if we look at Orbis's numbers over the long term, because obviously there's far more data globally, if you're getting 6.5 decisions right out of 10, you're probably in the top 10% of managers in the world.
Oh, wow.
And if you think the difference between 5, which is random, so in other words, you're getting half right, and 6.5, the difference between being like not a great manager and a great manager is actually quite a little bit. So I'd rather go like one thing I'd mention is when did it really work? And so the one thing that's built into Allan Gray's DNA, in fact, I'd say seared into Allan Gray's DNA, is 97, 98. So we lost 30% of our clients in 97, and I think 30% of our clients in 98.
Because of the
Allan Gray.
crash.
So remember, there was the listings boom in South Africa, happened 2 years ahead of the NASDAQ in the US, and everything was just flying. I mean, just like banks were trading on 4 times NAV. You had data, you had data tech. It was just crazy, right? And people looked at us and said, "You are people from the old days. You don't understand how to value businesses." I remember going to the Met, the horse race, and UBS, the stockbroker, had like 3 people doing sales for IT sector. And if you think in South Africa now, the only IT share that's left is data tech, right? So it just shows you how extreme it was. Yes. And it was an incredibly difficult time in the business. You go there and clients are firing you. And, from the middle of 98 to the end, we ended up having a 60 alpha year. And I think it was only us and Ford who were value managers at the time. So that's kind of built in, even though no one invested team other than Sandy McGregor was still around then, because that's sort of 3 years before I joined. It is sort of built into the thing. But no, I mean, we get, it's one of the things we think a lot about, is you don't want to use being a long-term investor as an excuse, right? So I think about things like Nampak. There are lots of companies where, we've just been wrong. And so we do think probably over time, we've tried to build it a little bit into the process that I actually listened to one of South Africa's most successful hedge fund managers do a presentation on why they shorted Nampak. And we own Nampak. And everything he said, we knew before they did. But we said, we're long-term, things are going to revert to mean, even though we know there are these problems. So it definitely, we make loads of mistakes. I guess what you want to try to do is you want to make the mistakes in small positions, not on the very big ones. Yeah.
And how do you convince clients to stay or remain invested for the long term? Because that's quite a difficult decision, and clients are worried about cycles in the market. And we know that a lot of clients want to get out when they see their markets tank, because that's the only time they call their financial advisors, right? Yeah. So how do you get them to do that?
So I think it's actually one of the sort of, if you look across the 50 years of Allan Gray, it was one of the big changes. So remember, we started the retail business in 1998 at a very opportune time, right? Because prime was 24%. Yes. It was the Asian crisis. So Simon and everyone was like, everything's so cheap. We'd only managed institutional money before, and it was very frustrating, I think, for the firm at the time, because we'd done a really good job for the pensioners institutional, and when they got their money out, they give their money to stand up. They give it to like all these people, because we had no retail business, right? So I said, okay, we need to get into retail. And thank goodness we did, because if you look what's happened to institutional businesses over the last 20 years with no job growth, I mean, you basically have net outflows even if you're doing well, and we've basically filled the bucket by having inflows into retail. And then what we learned was, okay, you need to educate people, right? Because we're going to look different, and there are going to be loads of times where we underperform. Alpha does not come in a straight line, right? So our performance tends to be quite chunky. when you look over time, it looks great. And we actually have a very interesting debate about, people look at 3-year rolling performances. If you did that for Warren Buffett, you'd fire him lots of the times, right? But if you look at the cumulative graph, it looks fantastic. You don't even notice the 3-year sort of underperformance things that happen. So we realized then we need to change a little bit from being this sort of secretive, sort of mysterious sort of Allan Gray that people didn't know. And you had to go out and you had to speak to people. And Johan de Lange, who's now obviously MD of Allan Gray Australia, and Jeanette, and everyone did a great job in building this thing and getting our BDMs out there and speaking to people and educating clients. Say, listen, this is how we invest. This is what we do. Because what you want to do is, I'm sure you're aware, the average manager underperforms the index, and the average client underperforms the average manager because they buy high and they sell low. So we've tried to reduce that gap. And I think we're pretty proud, and I don't know if the number, you guys, there's so many managers in South Africa, I don't know, but our gap's one of the lowest. So the average Allan Gray client still underperforms Allan Gray, but we've tried to reduce that gap. And that's really about doing things like this, right, and speaking to people.
Okay, so let's talk a little bit about your ownership. Allan Gray is not like your typical company. You've got the strong anchor shareholder, and I must just get it right, the Allan and Jill Foundation, and you've stayed away from being listed. Okay, how does this ownership setup influence the way you make tough calls when things get rough?
Okay, so you said, like, what have we learned over the 50 years? And if I was sitting on the other side of this webinar and I was a multi-manager or a consultant, the number one thing I would look at for an asset manager is their ownership structure. And it says, right, that's the thing that matters. So we've always said at Allan Gray, we could take an average investment team and produce above average results because of the ownership structure. Obviously, we want both. We want above average people in the boat. So why do we say that? Well, investing is probably the hardest business I've seen out of everything. That sounds terrible when you think about steel making and miners, but the psychological barriers are so huge because your scorecard's in front of you every day, right? So how do you take that away, right? How do you get the investment team and the business to focus on the long term? Because it's not just the investment team, it's the business as well. So having sort of the Gray family, and then, I mean, I'm sure as everyone knows, Allan donated the money, so it's one of the great things. When you walk into a studio, the majority of our profits go towards philanthropy, is that shareholder takes a very long-term view. We're not listed, so we don't have to report results every 6 months. There's no pressure on short term. So we want to do well all the time. So if we're doing badly in the short term, you'll feel it here. But so you're able to take a long-term view. And if you think about the shareholders, so it's Allan and Jill Gray Foundation, which is based in Jersey. It's perpetual. It lasts forever. The other shareholders are our empowerment partners, E Squared, which effectively fund sort of the Orbis Allan Gray Foundation. Then we have present and previous execs. So my sort of 2 longest-term bosses, Stephen Mildenhall, Ian Little, are still shareholders in Allan Gray, right, today. So, and then we obviously have current staff, and we have a staff scheme which can be allocated up to 14% of Allan Gray. So there'll be lots of younger people there, but on those older people and the things they know, investments go through cycles, and there are going to be periods where we don't do well, and you're able to take that view, confidence longer, rather than sitting there, oh my God. And the example I always use, you were nice enough to say our nice offices over here, but we used to be on the other side of the waterfront on Granger Bay. And in 2009, we could see them building the Cape Town Stadium. Okay. Remember the famous days of the David Shapiro 2010 fund, and everyone's like infrastructure, construction stocks. And we were actually called by some of our biggest clients to ask, why didn't we own construction stocks? We were like, well, they're trading on 5 times book value. They used to trade at 1, and construction businesses are poor. But looking from my window, I could see the stadium being built. And if my sort of pay and if the firm depended just on the 6 months, you go, I need to own construction stocks. So it's just trying to reduce all those barriers to that short-term psychological things. And it's just great to have like this anchor shareholder and to have people who understand investing. I think it's very important.
So you said 2 things, and I'm going to pick up on both just now. I'm going to get back to the younger people, but I want to talk about philanthropy.
I mean, people under 40 when I say younger.
I don't know what you're talking about. I'm 27 like you, right? So I read that you have a dedication to being a responsible corporate citizen.
Yes.
And can you tell me how Allan Gray gets involved in these philanthropic shapes, and how does it shape your culture?
Sure. So it's actually been very interesting to me. Some clients don't care.
Okay.
Some clients do. right? And we always make it very clear. Our clients are big shareholders in Standard Bank. If Sim decided tomorrow he's going to give away Liberty, we'd vote against it. Right? So we're in a very fortunate position that Allan wanted to give away. And when you look over time, most of the wealthy people who make a lot of money, in the end, they give it away, right? And it's very hard to give away your money. You might think it's easy. Like, it took years and years and years to set up the foundation and how it works. So effectively, the Allan and Jill, it's a global philanthropic operation, because they're also obviously majority shareholders in Orbis, and they're shareholders in Allan Gray Australia and here. And the dividends from the firms then go out and they're put into various things. And then we also have what we call the Allan Gray Orbis Foundation. So the firm donates 5% of our pre-tax profit. So we actually, I think, the biggest foundation in South Africa. And that goes, Allan's view always was, the people who are going to fix South Africa are not Anglo-American. It's not Standard Bank. It's not SA Breweries. It's entrepreneurs. And how do you get entrepreneurs? Well, you also have to be educated. And Allan was always a big believer in good education. And so, we put all these people through university. There's nothing to come back to Allan Gray. And then sort of the E Squared, our empowerment shareholder, they can approach them for funding to start businesses. And all their time during university, they offered sort of training, and they get together. We've built up like this huge thing where all the people, we call them Allan Gray Fellows, when they finish, they meet. Right? And I think we've got like businesses worth a few $100 million now that these people have started, and that's really how you're going to make a difference. And other than that, we've also got an interesting thing where Allan and Jill still had a little bit of their stake in the business, which didn't go into the foundation. And once every 3 years or once a year, the staff can actually choose. All of us can vote, and people can put forward charities and things that help. And it's a reasonable amount of money. It's quite a bit of R1 million. We get to choose where it goes. And as I said to you, it's different. For some people, it makes a difference. Like for me, it's like a cool thing, right? We work for things and we can make a difference. And I think also why it's important is if you take, so I sit on the board of Allan Gray, if you take like a 20-year view, we've got lots of things to be worried about this country, right? And Allan Gray is not going to be a successful company in a country that fails. So you want to be, what can you do? And my favorite sort of way of explaining it was, one of your competitors, I won't name them, I think they're called PSG. They were hosting a big, their big conference at Sun City, and I was presenting. So I went to check in at the Cascades, and they said, "You have a business card?" And I never have one. I was like, "Okay, here's my card." And the lecturer said, "Are you from Allan Gray, sir?" I said, "Yes." She said, "You guys put my brother into St. Albans to school, and you changed our family's lives. Thank you very much." I said, "Oh, that's fantastic. Would you like an upgrade?" I said, No, that's not the way it works." But so you actually make a real difference, and we get to meet a lot of the people from the foundation, and I think it's very important for our country, given that sort of businesses, we the people who actually have to make the difference now. And just to remind everyone, on a global scale, the philanthropy does stuff obviously in America. We actually even do stuff in Rwanda. So it's something that most of us are quite proud to be a part of.
That's quite inspirational. Yeah. And do all the staff contribute, or participate in those?
Well, on the staff thing, everyone gets a vote on where we dedicate the money. But really how all of us contribute is the better the firm does, the more dividends there are, the more funding there is for the philanthropic purposes. And that's actually how you make the biggest difference, is if we do well for clients, Allan Gray does better, there are more dividends that could be able to go to the philanthropic purposes.
So a nice win-win situation for everybody and the country overall, which is great. Coming back to the young employees. So Allan Gray is known for taking people directly out of the graduates essentially, and molding them into the Allan Gray view, if you want to call it that. What would you say are pros and cons of that?
That's a good question. So just to put it into context for everyone, we're about 1,400 people, let's call it roughly. The investment team's only 26 of the 1,400, because obviously we have the platform, we have IT. So we're not just, we actually, we don't outsource. We're going to outsource a little bit to JP Morgan, some of the middle office functions, but we do most of the stuff here. Our client service center is right here above us. It's not sitting in Pardon Island or somewhere. So we've always said you want investment alpha and service alpha. Coming back to your point about how do you keep clients. It's an interesting thing. On the investment team, it swung both ways. So we've actually gone a little bit where if you've actually had a little bit of life experience, maybe it's better to hire someone after a couple of years. It's also if people come straight out of university and they come into a firm like Allan Gray, they think this is normal. You say, I'm like, okay, let's go and work. We sit next to INJ here. Go and work for a fishing company in the things here, where, so you think this is what a normal job is like. So I think it works both ways. Like sometimes, Simon Marais always used to say, and people differ on this, your best chance of being a great investment person is right when you're young, because you have no biases. If you listen to Stanley Druckenmiller, probably the world's greatest investor, he'll say it's when you're 33, 34. If you listen to Ant Lester from Willis Towers Watson, it's probably South Africa's most well-known investment consultant, he'll say it's like when you're more experienced. So it's different to get it right. I mean, do we want, our staff turnover is roughly somewhere between 10% and 15% a year, which is good because you want people coming in and you want people leaving. And I always say, like, after a couple of years, you can tell, you go, okay, that's an Allan Gray person. And it's hard to like put it into words, but that's sort of the way I think about it. You can see someone sort of, okay, that person's an Allan Gray person. And we've tried really, really, really hard. So Mahesh Cooper, who's our Chief Operating Officer, my good friend, and Ian, the Chairman, and the board, we try exceptionally hard not to become bureaucratic. But when you have 1,400 people, you have to have some rules. But generally, we want people to say, I'm an Allan Gray employee. In this situation, how would I act? And that's what we try to get through.
So Duncan, that's very impressive. I like the fact that you're able to differentiate people and say that's Allan Gray people. That's amazing. And I suppose once you've got there, you've said, okay, I've earned that, the right to say that, and that's very impressive. But I found it interesting and all these people are smart, hardworking individuals. And could you tell us a bit about the qualities that Allan Gray prioritizes?
Okay, so I'm going to speak mainly about the investment team here. If you're a very good IT coder and you live in a Marnus and you don't wear shoes, and they're like, that's great, right? So, first of all, the one point we want to make, so we've always said that when people ask what makes a great asset manager, is smart, hardworking people. But all our competitors have smart people. So for us, it's like a ticket to the game to hire good people, right? But we know, like, we have great respect for all our big competitors because I've known lots of the senior people for years, and they're very smart. It's not like I'm smarter than them. So what do we kind of look for? So we look for, and let's just say in South Africa, it's difficult at the moment. The competition, we're a small company compared to you guys, right? And the banks. So like the two people we recently hired last year in the investment team, they already had permanent job offers in their second year of university. So people didn't even bother to see how they did in third or fourth year. Right? So that's how the competition is for talent, especially really good young black people, because everyone is chasing this small pool, right? So what we look for sort of, we've noticed a very strong correlation between people who do well and their academic marks, which kind of makes sense. It doesn't mean you become, and after that, it doesn't mean just because you're smart, you become a good portfolio manager. Then that correlation breaks down a little bit. But generally, if you've done really well at university and you've got strong marks, you're going to do okay in the investment team. We like people who have independent thoughts. That's kind of how we do. So you can interview a person and you kind of get a little bit of a feel, although it's tough, right, to this, so independent thought. Also, like, people who are interested in the world. Like, are you interested? If you're going to come in investing, you have to be like curious. You have to be sort of wanting to find out what's going on and doing those type of things. And as you go on, one of our competitors, they call it this, and I stole it from them, is EQ, not IQ, right? So managing money is hard.
It's highly emotional.
Yes, as you go, yeah. So I mean, the balance fund's 184 billion rand, right? So sometimes, like, my friends are like, Duncan, like, how do you sleep at night? I go, well, I don't think about it like that, right? I think about it in percentage terms. But when you look at people as they get more senior, and you're going to manage money, you're also looking for the type of personalities where okay, you're going to stand in front of someone at the point in the cycle where you are, your alpha's negative over 5 years. And you're standing in front of them like, how are you going to, I'm competitive, right? So if someone says, oh, Allan Gray sucks, I'm going to hate them for saying that. But you're not going to say that to the client, right? So you need to stay there and you need to sort of have that sort of thing. So yeah, it's a mixture of things. And what we've tried to do over the years, when you look at our investment team, one of the criticisms, but one of the interesting questions people ask is like, is everyone a CA?
Is everyone a CA?
No, but the vast majority are. As I said, I'm a failed CA, so it doesn't count.
No, that doesn't count.
So we try to we've got like a PhD in industrial engineering now, we've got like some science people, mathematicians. So we try to get a mix of people. And the really interesting example I like using is AVI. So if you guys know, it's the second biggest food business in South Africa. So if you're drinking tea now, eating a biscuit, it's probably one of theirs. But they also own Spitz, right? The shoe company. And when they bought it, this is many, many years ago, we were like, this is crazy. And we sold all our shares.
But right up your alley in terms of contrarian, right?
Yeah. So we just sold. We said, like, who earns 2,000 Rand or 5,000 Rand a month, but pays 2,000 Rand for a pair of shoes? And why did we think that was wrong? Because we were stupid, dumb white guys. If you had young black people in the team, they go, Carvelos, these are like a status symbol. This is something people want to do, and you get it. And actually, in hindsight, leaving aside the economy doing bad now, it was an amazing acquisition for AVI. And it just shows you want lots of diversity of thought. So we also encourage people to read a lot. Sandy McGregor, he's been here like longer than most of us have been alive, like telling the stories from sort of 1990 or doing things. So we encourage people to think. Right? So I know you said there's an Allan Gray way, but often people from the outside think like we brainwash people into thinking like one way. There's a philosophy, how we think about things. There's a way we approach things, which I think you need to be. But we really want people to say, the young guy we've just hired is 24. So like, Duncan, like, why the hell do you own MultiChoice? I only watch YouTube. Are you crazy? And you want those kind of ideas to come through.
Okay, that's great. So what we're going to do now, Duncan, is we're going to go take some audience questions. Cool. Let's just pull it up here so that I can see what's going on. So our first question is from Anonymous. We are in an election year in South Africa. What potential downsides does Allan Gray foresee which others might be missing?
So I don't think there's any downside that we see that other people don't. I mean, if I was actually had dinner the other night with Morgan Stanley, RMB Morgan Stanley, and they get to speak to the foreign investors a lot more than we do. And we've also met some of the big ones. And the consistent feedback they have is basically foreign investors are waiting on the sidelines to see what happens in the election. And I mean, everyone's got their own political views, but the kind of view of foreign investors is, as an example, if the EFF are in any way involved in the national government, there's a chance South Africa becomes uninvestable. So there's an example of a downside, right? So the way we would look at it now is an ANC-EFF coalition is not priced in, nor is the Moonshot coalition winning priced in, right? I think what most people want, which I personally find fairly bizarre, the market would want the ANC probably to get 46, 47, and then partner with someone on 4%, and then everything stays the same. So we just get worse and worse and worse every year slowly, right? Whereas what I think would be good for the country is a change, but it would probably mean you have a lot of strange things happening for a year or two. You only have to look at the coalition governments, or councils in Johannesburg, Pretoria, those type of things. So we were actually very surprised. About a year ago, we've been talking about it because we've been thinking about it with the portfolio, and like no one was asking us about the election. Now, it's like the only question you get when you go and do a client presentation. And we're not political analysts, but we're fortunate enough to meet very interesting people. People value Allan Gray's view. So we look at it. So we think it's an important thing. The thing I personally worry about, and we're thinking a little bit about in the portfolio, is if you read the newspaper every day, which is sometimes quite a tough thing to do in South Africa, there are all these people who steal a lot of money.
Corruption has a high.
If the ANC is going to, well, we know for sure the ANC is going to lose Gauteng and KwaZulu-Natal. All these people, I mean, they kill each other, right? Let alone, so all these people who are getting these cash flows from, are they just going to give it up if they see the ANC? So I'm a little bit worried about sort of end of March, April. That sounds a little bit time-like, but I think there's like a 20% chance or a third chance of like a repeat of the 21 riots. Just because I just can't see all these people who are earning all this money by doing devious things just saying, that's fine, I'm leaving, thanks very much. So, and then just out of interest, we actually said it at the beginning of the year, if anyone watched our webinar at the beginning, was this is the year, based on a Deutsche Bank study, and I hate to be the poor junior person who had to go and study it all the way back, from 1870 to today, this is the most people as a percentage of the population of Earth that are voting in any year. Because you're voting for the EU Parliament, it's obviously America, India, Taiwan, which we read, us, and a couple of, so literally almost half the planet is voting. And if you think in China you don't vote, it's very interesting. So the world could look very different in a year, because if we look at the way politics is going, in Europe, the current incumbent parties are losing. If you look at the polls, whether you believe them or not, like Donald Trump might win, and you have like these, so the world could look like very, very different in a year. The policies we've seen over the last few years to where they are. Whether they're good or bad depends on your own sort of opinion on the world. I'm more like it'd be nice to have a change type of person, but let's see.
And that would be very interesting for investment, obviously, and the decisions you make as a long-term investor if the world looks very different in a year's time.
I mean, as an example, oil and gas. Mm-hmm. You just change the government and then it becomes, so I don't, people who follow the news closely would see that many states in America now have banned ESG as part of investments. Mm-hmm. And in Europe, the fastest growing parties are generally parties that are based on like people who work in agriculture and stuff like that, because it's been very underreported. But if you watch closely, all these protests in Europe, that's got a lot to do with sort of environmental policies where they want to shut down farms, etc. Mm-hmm. So you could be in a year and everything is very different. So we, I think the one thing that's kept South Africa sort of going is the private sector. Mm-hmm. So we have an amazing, resilient private sector. And that's sort of the one scenario which is very, very interesting, is something good happens, our bond yields come from 12 down to 8. Mm-hmm. Standard Bank trades on 12 times earnings instead of, like, there is a scenario where, like, South Africa really rips. And it's very interesting because when I started, the 2002 was a down year, but the all-share index was 7,000 and it went to 49. That's up 7 times. So that would be the Aussie today at like almost 500,000.
Yes.
And we're only at 70. So like, people can't even imagine what it's like to work in a time where South African asset prices go up. Yes. At some stage it's going to happen.
Yes, for sure.
You think. And there is a scenario, I mean, it's not our base case, obviously. So we've tried to like position the balance fund and the stable fund where we have asset allocation ability to perform reasonably well in most scenarios. We haven't taken a South Africa Inc., South Africa's going to do great, or South Africa's finished, everything's offshore. There are lots of cheap assets in South Africa, but we do think it's good to take advantage of diversification as well.
100%. I'm going to move on to our next question. It's from Derek. Thank you, Derek, for your question. Are you concerned about the trend in JSE delistings and the declining opportunities in local equities?
So it's a good question. Like, we actually wrote a paper, Nadia and Stefan, where it's not as bad as you think. If you go back through history, it's always happened. I mean, Sandy McGregor will tell you when he started, there were 70 gold mines listed on the JSE. Now there are 3. So, 5. There are things these things go through cycles. And generally in history, what's happened is when prices are high, people are willing to list businesses. Businessmen can see they can sell it. But the South African stock market in dollars is flat since 2006. Yes. So if you think about that, it's 18 years. You haven't made a cent in dollars investing in the South African stock market if you put a lump sum in at the time. So prices aren't like enticing. But I think that it's not just a South African trend. It's a global trend with the huge growth in private equity and in venture capital. Lots of companies looking and go, do I really want to be listed, right? I'd rather just get private capital. I don't have to do with listing requirements. I don't have to report every 6 months to people. And that's happened in the US. It's happened sort of everywhere. If you look at the UK as an example, which I always tell people who are bearish about the JSE delistings, most UK companies are being encouraged to delist from the FTSE and list in America so they can get a higher rating. Even though it's bizarre, it's the exact same company. Yeah. Where I am concerned is, when I started, the companies that were listing, so people quote the number of delistings, but if you actually look at the delistings, and I don't mean to be derogatory, a lot of them are pretty crappy companies, right? They're like small, it's it's not like a Distel delisting, that's like a bigger thing, or whatever, like those are things. But when I look back, the companies that started when I did, Mr. Price, Discovery, Aspen, where are those businesses? The only one we know of, ironically, the only company listed that did really well was Transaction Capital. Now it's all reversed. But the only quality listing we know that's coming, because they pulled it, is the Coke bottling business. So we're hoping they list, because they're one of the biggest Coke bottlers in the world. So to me, it's more the quality. But then you go and ask younger people, and they go, actually, where is all the potential of those new businesses? It's fintechs in Stellenbosch. It's people trying to come up with an app that can sell to Stanley. That's like where a lot of the capital's gone, and those people don't want to be listed on the stock market. So let's see. I think if we have a bull market in South African equities, there'll be businesses that will list.
100%. So you spoke about ESG earlier on. Here's a question from Anonymous, also on ESG. In a continuous changing global climate and with the need to chase alpha, how does ESG affect long-term investing?
So it's really hard to answer that question. So just to take a step back, how did we approach this at Allan Gray?
Yes.
We didn't say, invest with us because we ESG focused. We want to be a great asset manager that integrates ESG. Why is that? Well, if a gold company pours sulfur into a river,
you want to be able to call them out on that.
well, you don't want to call it, the company's worth much less.
Yes.
Anyway, right? So we value things on a sustainable cash flow. And even though I might disagree with a lot of things that are happening in the world at the moment, like you need to sell to your customer base, right? So you need to take into account what society's sort of thinking. So we've always been very well known for governance. So if you go back to where I started, we have voted against boards. We meet non-exec directors, chairmen sort of all the time because, as Charlie Munger said, show me an incentive, I'll show you the outcome. So we spend a lot of time on that. And remember, Allan Gray doesn't own a single share in South Africa. That's our clients who do. So when we meet boards of directors, we meet management, we're representing our clients. On the E and S, so I have two comments. One is E, S, and G all interact. And so I was fortunate enough to go on holiday to Berlin just when Russia invaded Ukraine. And to see how Germany, now all of a sudden you don't have energy, then people go, actually, we want secure energy. We want cheap energy. We don't care where it comes from. So I think there's been a big shift where, as in anything, you have a trend and it goes like a peak. So I think we're well past peak ESG. You can just see it's settling down as it normally happens. It matures. You say, okay, guys, we need mines. We need oil. Everything we're sitting here in this room is a byproduct of fossil fuel of some sort. And yes, there's human ingenuity. There's lots of capital. I think we'll be okay. So the trend we've noticed in South Africa, which is very interesting, is there's a lot less focus on the E and a lot more focus on the S. And I think it's just the nature of where we come from. Like, what are businesses doing? Employment. Like, what are you paying people? And so I think there's been a much bigger focus on the social bit. So it's a complex topic. It's an emotional topic. Funny enough, often we get advisors come to us and say, thank you for not preaching to us. Right? So I think that's where people feel a little bit like, the economy is so hard. I'm trying to go to work every day. I want my kids to do it right. Like, there's all these other things I have to worry about at the moment. Like, can you just leave me alone for a bit?
And now you're telling me about economic and social governance and things like that. I don't want to hear about that.
And then obviously we've seen like lots of the investment firms overseas have been caught out for greenwashing. And you would have seen someone like Moody's had to re-rate 3,000 funds. And that's why we've always been against, we're speaking to a platform. In South Africa, like, people wanted like people to have an outside person who rates your fund. A 3, a 4, a 5. Like, what does that mean? And then who are you going to use? S&P, Moody's, Sustainalytics, they all come up with different answers. So we at Allan Gray, we have our own scorecards. And if it ever comes to the thing where you say, okay, like, Stanlib's never going to invest in Allan Gray unless we have, like, maybe we'll get one outside provider, but we'll put a proviso there that says, here's a number. That's not how we do stuff. We think about things seriously. If you want to know how we think about gold fields, about mining, about water, about sustainability, we can show you how we think about it. And we think that's a better, more sophisticated way to go about it. We did actually, I went to one presentation where one of our competitors used a good example of they got outside people to rate Anglo-American, and they were rated as an alcohol company.
Oh, okay.
Not a mining company. So it's just like, some of the information is not that great.
Great stuff. Duncan, I want to talk a little bit about incentives. It's interesting to know about Allan Gray's approach to incentives, especially the emphasis on aligning staff incentives with client outcomes. And you touched a little bit on that earlier on. How does Allan Gray ensure that the incentives for his staff are aligned with the interests of the company? Yeah.
So as I mentioned earlier, as I said, if I was on the outside, I'd look at ownership. And part of ownership is incentives, right? And if you think the bad reputation the financial industry has, especially post the great financial crisis and whatever bankers and people think of the financial industry in generally a bad way if they don't understand, it's because of incentives, right? Bad incentives. So when Allan, his fundamental belief when he came back, he actually wrote an MBA paper at Harvard, the first one ever to propose performance fees for a long-only manager that's not a hedge fund manager. And today you might think, oh, that's it, but like, it was quite revolutionary back then. And he really believed that we shouldn't exist if our clients don't do well. So how do you do that, right then? So a majority of our assets are on performance fees. And trust me, as a shareholder and as a director, I know how our profits fluctuate because our cost base doesn't change much, with the revenue. So he really wanted us to walk in the same shoes as our clients. If the clients do well, we must do well. If the clients are not doing well, we shouldn't do well. So how do you do that? Well, Allan also believed he wanted the senior people to think like owners, not managers. And we know, like if you look at a business successful as FirstRand, GT, Paul, Laurie, they started, right? So if you look at FirstRand, we think it's probably the best run business in South Africa. There's an ownership culture that goes through it, and that's exactly the same at Allan Gray. So how do we do that? So for the senior people, like for me, of the top 3 PMs, I haven't had a bonus since 2005, right? So what works is my salary goes up by inflation, and then I was given the opportunity to buy equity in Allan Gray, which I had to borrow from the company. And then we also have something called a profit share for the senior people. So you're able to share in the profits of the firm. And that's quite important if you think about it. If you think a lot of our assets on performance fees, so we do well if the clients do well, and then you share in the profits of the firm, that means the staff are directly linked to the clients. And it's an interesting because also it's quite long term. So for the investment team, the people who qualify for the profit share, you can also earn it well after you leave, right? Okay. So like on my current on a current one, you might say, okay, here's a 3-year measurement cycle. Let's see how you do. And then the profit share you earn from those 3 years lasts for another 6 years after that. So actually what you do today matters for the next 9 years, right? So you're really trying to get that long-term point of view. And then we also have, as I mentioned in the ownership structure, the staff scheme. So that's brought, so it's part of our empowerment initiative. It's part of like sharing some of the wealth in the firm. And there, if you get a certain rating in the firm, so if you've done very poorly, you're not going to qualify for the staff scheme, but you get the ability to choose, do you want your bonus in cash, or you can take part of that bonus and buy effectively a profit share in Allan Gray at a very attractive valuation. That also means that we've built it up to a nice thing where staff, they see, wow, we're doing well for clients. Look at the end of the year, I put my bonus last year into this profit share, and hey, I'm getting these good dividends. So everything is trying to align how we do with how the clients do. And it's rough sometimes, right? It can be rough. If we're not doing well, you have to sit there. But I think what's sort of most important to me, in fact, I've been through a few meetings, like one was with Stanley the other day, like people are like, why would anyone want to stay at Allan Gray? Right? And I think what we really try hard in the investment team is not to make it only monetary. If someone's only working for you because of money, in my experience, that's not a good idea, because one of your competitors, if they need someone for a specific job, can come and just pay up massively, and you're not going to match that. And what your best defense for getting people to work here is it's a great environment, they want to be part of the team, and they're proud to work at Allan Gray, because that's a much harder thing to do. And sometimes I see people's CVs and they've worked at 5 places and they're only like 28, and you go like whoa, what's going on here, right? And so we try to build that sort of thing, and also you want people to be proud of, as I mentioned earlier with the FirstRand example, you want people to be proud. Is it harder with young people? it's harder. Like you just have to be blunt about it. Like sometimes I look at the way like 23 or 24-year-olds look at the world today, and you go, jeepers, that's very different how I think about the world. So you need to adjust a little bit for that. It's just to be like, you actually have to work to earn money,
Of course, and that's where the difficulty comes in, managing those 2 generations and thinking how you're going to take that forward, especially in a growing company like Allan Gray.
Yeah, no, it's frustrating at times, but you try to learn from younger people because they come with fresh ideas. But we also say, okay, this is our culture. This is kind of how we do things. We think it's worked through lots of different cycles. Will we adjust over time? Of course, you adjust a little bit. Do we want to get better? Yes, it's one of our great things we focus on the investment team is getting 1% better a year. And that sounds terrible to people, and I know all the advisors, they understand compound interest. Do 1% better versus 1% worse over 20 years and look at the gap between the two. So we try to get better, but eventually I think what we do well here is if someone's not going to fit in at Allan Gray or not understand our culture or how we do things, that's fine. There are other places to work, And
James Clear, in his book Atomic Habits, talks about getting 1% better year
Yeah.
or each day, and I think by the end of a certain time you're like 27 times better than you've ever been, which is absolutely great.
I don't think people realize how competitive the asset management industry is in South Africa. We think, we obviously aim to do better, but we would think a 2 alpha after fees is hugely respectable. 2%.
It's huge.
That's not a lot. If you say to someone, oh, I'm only 2% better than you, people go like, oh, 2%, like what's that, right? But actually, it's extremely hard. I mean, if we go tomorrow and whoever, Mr. Price issues a profit warning, Carl and Neville at Coronation are looking exactly what we are, right? So, like, why are we better than them, right? So you need to, like, it's extremely competitive. The one thing I would say that I think is going to happen, which might be interesting, is I think a lot of the smaller asset managers are really struggling. And for one reason, like the market, as I said, in dollars hasn't gone up in 18 years. And if you're making 70, 80 basis points and your revenue is not going up, and you have a cost base at pay Microsoft Office, you outsource to an investment bank, part of it's dollars. We've got 45% offshore now. People say, well, who's managing your offshore money? Like, you have to hire another 2 analysts. I think it's pretty tough out there. So I wouldn't be surprised if you don't see a lot of consolidation in the asset management industry.
That's interesting. So you think there'll be some sort of consolidation and smaller managers will integrate into bigger...
Well, or they'll merge with each other, or they'll just go out of business.
They just got it.
I mean, you can actually do the maths. It's really tough out there. I mean, we can see for even ourselves, it's your cost base is going inflation plus, and the revenue, we'll have like 1 or 2 good years. So I think, and yeah, it's probably it's very different if the market was going up a lot, then the pie would be bigger. It's just our kind of feeling is, and in South Africa, obviously, passive's market share is low as well, which could change, but it'll be interesting to see if it does. I don't know if you know, in America now, of retail funds, passive is 54% market share.
That's huge.
So it overtook active about 2 years ago.
And that goes against the Allan Gray philosophy completely. Yeah. How do you expect to manage that?
So it's interesting. So the maths. I've been in many conferences where I've had to debate someone who runs a passive firm. I'm not going to mention their name. So there are a couple of them in South Africa, and even 1 or 2 international people. And they're right. The average passive fund will outperform the average active manager. The only thing you do know about passive is 100% sure you're going to underperform the index, right? And in South Africa, the weird thing is some of the passive funds can have quite a high tracking error just because our market's so concentrated. In other words, what I mean is you obviously have to invest to mimic the index, but things can happen where you can't mimic the index. And interestingly enough, when we did the study, there were quite a few passive funds in South Africa whose tracking error was bigger than our active fees.
Wow.
Yeah, I mean, like 1% doesn't sound like much, but that's bigger than our fees, right? So on some of things. And I think it's fine. And I have nothing against someone who says, he has a diversified index, like the S&P 500, I'm going to own it, because maybe if you passive investing, you're a momentum investor. Right? So the Magnificent 7 are 33% of the S&P now. That's great. You own them because they've become big and they're doing well. But obviously that works the other way around. And the example we like to use is when Allan launched Orbis, Japan was like twice the weight of America in the world index. The exact thing you didn't want to do was own Japan. At that weighting, you wanted to own America. But it's great to have like this competitor against you, this anonymous competitor, the index, and it is valuable. But what we more think about passive is the effects it's had on the market, especially in places like America, where a passive investor doesn't care if Apple makes phones or farms apples, right? And so eventually we think it has a big effect on the market, and it's distorted a lot of market trends, and it'll be interesting to see how that plays out over time.
Duncan, here's an interesting question from the audience. What are your top 3 investment books to read? That's from Anonymous.
Okay. Yeah, I've read so many in investment books. It is the one thing, over time, you, not just investment books, but people I think are really good. Like, after all these years, I've narrowed it down to, you do worry you get into a bit of an echo chamber, but there's sort of like 10, 11 sort of people. And now, I'll get back to the books now. The one thing that's changed a lot is podcasts. So if you're willing to spend some time, because we know, like, that's why we pushed the Allan Gray podcast, we get like 3,000 people who listen to, which was quite big for South Africa, right? But it's an easy way to speak to clients. But there are some incredibly smart people on podcasts. There are too many podcasts, but if you go and find someone, there's some really good sort of stuff. What are they in? I'd rather speak, like, so the one thing I think is quite relevant for today is I like reading market history. So I was actually thinking, because I knew you might ask me about bubbles, is Devil Take the Hindmost by Edward Chancellor, is a history of bubbles. It's a very interesting book to read. I like anything by Jim Grant. And then they're just like, there's so many investment books, it'd be really hard to like distill it in a little bit. But the one kind of thing I've noticed about if you read a lot, so I'm a big fan of reading a lot. Right?
Okay.
I think my record during COVID was 53 books in a year.
Wow.
Yeah. But you also want to mix fiction with non-fiction. You still want the thing where the guy saves the world, gets the hot chick, somehow has money, like you don't know what happens, solves the whole problem. But to read widely, you don't notice it every day, like you think. But it builds this knowledge, And someone says, Duncan, why have you done this in the portfolio? And you're like, I don't know. But it's like this knowledge that you've built up over time. So I'm a big fan of reading and sort of also trying to understand behavioral sort of stuff as well.
That's great. 53 books. Wow, very impressive. I had a...
They were all over 100 pages. It wasn't just short ones.
So it wasn't those big, large picture books or anything like that. That's very, very impressive. I'm going to get you one last question. Do we have enough time? I actually don't think so. We're actually out of time. Thank you very much for the conversations today. I had so much of fun, and thank you so much for hosting me at your offices. Please grab us the next time for In the Room with, we're actually going to be talking to around asset allocation with the INN8 Invest DFM team. Thank you very much.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.